which is also another sector that we've been getting lots of questions about over the last month. And ladies and gentlemen, I want to take a moment. Michael was the head of HSB Property for 20 years in the commercial sector and knows lots about it. Ladies and gentlemen, Michael Salvartsis.
Thanks, Richard. Okay, I'll try and make this quick so we can all go grab some lunch actually, but Real Property Advisors is our business. Basically there's the disclaimer that we're all hoping is going to get us out of all this. The commercial property market, I just want to do a bit of a stock take on where we are from a commercial property point of view and also what some of the opportunities that are and will be available there going forward. Basically retail, I guess the only success story out of retail is supermarkets and shopping centres which are anchored by supermarkets. It's pretty ugly out there in the clothing space, it's pretty ugly out there in the food services space. The winner has definitely been household goods, and we're seeing companies such as Flight Centre as an example, re-looking at the properties that they are leasing, divesting of those and potentially, revisiting their portfolios. As I said, supermarkets are the success story going forward, and also those retailers who are able to secure their supply chain lines. It's very critical. Basically, the retail market has seen very little transaction for the first half of this year. Basically $833 million in transactions compared to $2.7 billion the same time last year. So we've got a lot of owners who are pretty much not wanting to go to the market at this point in time. And the reason for that is there will be a bit more opportunity in that retail space, especially in the area of trusts, where they really have a 5-year sort of redemption time frame. So we'll see a bit more of retail in the marketplace going forward. There's very limited transactions in the retail sector. Yields are shifting and expectations on yields are starting to shift. Prime CBD retail assets, they're always trophies, they're always very strategic, they're always hard to find. They will hold their values. And the reason for some of that is because it's a lot cheaper to own a property in the commercial CBD than going through extensive marketing, TV, advertising programs through the media. So sometimes it's cheaper just to have that presence in the CBD rather than actually paying advertising costs. Basically, a lot of investors are revisiting their portfolios, and what we're seeing is that they're moving or will be moving their money out of retail assets and putting them into other more secure sectors, such as industrial and commercial to some extent. Basically, there's just a graph here that just shows you the lack of transactional activity that's happened in 2020. So I think that graph speaks for itself in terms of the limited amount of transaction. Basically, now I just want to talk to you just a little bit around the country in terms of, these are the metrics for the second quarter of this year. When you look at it, these are prime CBD investment yields around the country. Basically, Melbourne is the sharpest yield in the country at 3.5% net. Sydney is at 4.5% and Queensland is at 4.75%. Basically, the rentals range anything from $3,755 a square metre in Queensland to as high as nearly $15,000 a metre in Sydney, the CBD. Just a quick talk about the office market. The key things to be looking at going forward is going to be vacancy rates, incentives and yields. If you look at Sydney, the Sydney vacancy rate, as is all other CBD office rates, is going to increase significantly. The vacancy rate as at Q2 was 5.4% in Sydney. Yesterday, Collier's released a report saying that's going to be just under 10% by the end of next year. So commercial office vacancies are going to increase significantly. Incentives are at 24%, and they are expected to increase to 30%. So what that means is, if you take on a 3-year lease in town, you might be able to get 1 year of that 3 years as rent-free. Basically, yields in Sydney are at 4.5%, the sharpest in the country. Vacancy in Melbourne is holding quite well. Incentives are at 30%, and prime yields are around 4.8%. The story for Brisbane and Perth is very, very different. We expect high yields as investors, so 5.3% in Brisbane, 6.3% in Perth. But if you look at the incentive levels, if you went to Perth, if you take on a 4-year lease, you might get 2 years rent-free. Okay. Similarly, as I said, the vacancy rates, so this is why investors expect higher returns out of Brisbane and Perth, is because the vacancy levels are a lot higher, and there's not that much, they're not deep markets. They're not as deep as the markets in Sydney and Melbourne. Industrial has been the most resilient market and will continue to be the most resilient market in the country. Logistics and warehousing is the areas or the type of assets that you would have invested in as success stories going forward. And they probably will continue to be very, very safe investments. Basically, if you look at the Eastern Seaboard, net face rents pretty much across Brisbane, Melbourne and Sydney have stayed the same. There are yield differentials, and I'll tell you what, when I was looking at this stuff 10 years ago, there was always a difference between a retail yield, a commercial yield and industrial yield. Pretty much industrial yields are pretty much at par of where commercial yields are today. So basically, and if you look at the incentive levels that are being offered on industrial property across the country, as I said, they're not at 24 or going to be at 30%, they're pretty much at 16%. They will change going forward, but as I said, they're a lot tighter than what they are in other asset classes. Okay, so basically, if you're in the yields that we're seeing out of Sydney are around 4.66%. In Melbourne, a little bit higher at 5.45%. There's a little bit more industrial land to be developed in Melbourne. And in Brisbane, it's nearly 6%. The forecast, according to Collier's, vacancy levels, so this is basically a stock take of where we are over the last quarter compared to what's projected for next year. Not a lot of exciting stuff happening. Supply levels will tighten. Incentives will increase. Yields will pretty much stay the same. Vacancies will stay the same. And rentals will pretty much stay the same. In terms of outlooks and opportunities, basically, as Michael indicated before, we're pretty much in the deepest recession that we're going to see. However, we still have investors, whether they're private, trusts, etc., institutional, still looking at investing in commercial property. The opportunities to source these assets are going to come from 3 main sources. One is from cash flow issues from companies or trusts. Second one will be tightening of bank policies. I was working for HSBC during the GFC, and what you're going to find is all banks are going to tighten up on their commercial lending criteria. So the underwriters back then all became credit risk managers, okay? So they were pretty much they were reviewing files very consistently. They were looking at lease expiries compared to loan terms, trying to whale them all in. There will be casualties in this space, but I think, look, it's probably the biggest point I'll make, but I think they might be more likely to work with clients rather than take a hard line. The jury's out, we'll just have to wait and see, but there will be opportunities in that space. And the other source of properties is in relation to trusts, where pretty much they have to send money back to their investors. They're normally on a 5-year time frame. So, for instance, Leader Holdings, it was in the news a couple of days ago, they purchased a couple of industrial properties, leased them up and sold them within that 5-year time frame. Big industrial properties in Ingleburn, and I've forgotten the second suburb actually. So basically, if you want to find where there might be opportunities to buy, pretty much look at the trusts, those who have acquired assets in 2015 and 16, and they are potentially exit strategies for those companies. In terms of hospitality and retail, they're obviously the most heavily impacted COVID industries. According to Cushman and Wakefield, basically they're expecting a repricing, or let's say an adjustment in pricing downwards of between 10 and 20% for hotels and around 10 to 15% for retail. As I said, there will be a divesting of assets out of retail and into higher returning asset classes that are going to be a bit more stable. At the moment, there will be better opportunities going forward and less price mismatch between vendors and purchasers. So there's potentially the ability for people and institutions to negotiate better going forward in hospitality and retail. The office sector is going to change. So basically, in relation to office, we no longer will have, the single office workplace. It'll be distributed across many different locations. We're on a couple commercial buying briefs at the moment. If you're looking at real commercial, you're probably tapping about 50% of the marketplace. I'm aware of nearly 20 commercial office levels across the CBD that are available to be purchased and are off market. So what I'm saying is that commercial's they're going to see a lot more supply coming through. Commercial expectations are very different. The other thing, I'm aware of some developers who are paying $18,000 a metre in town for commercial office. It's not worth $18,000 a metre, but what they're doing is they're targeting B and C grade buildings to get that 75% ownership component to then be able to revisit that asset, because from a residential point of view, it could be worth $30,000 a metre. So I had a really good chat with one of my developer clients. I said to him, why do you want to pay $18,000 a metre? He said, Mike, I'm happy to pay overs now because I know that I can get 75% of ownership of the building. It's a B and C grade building, so it'll be converted for other residential uses going forward. Basically, there will be a little bit of a mismatch in pricing and expectation. Commercial vendors are at this level, purchasers are not at that level, so we will see a bit of price mismatch. And in relation to the industrial sector, as I said, the industrial sector has been the most resilient sector in the marketplace. With industrial, it's not like other typical assets, classes or sectors. There's a lot of owner-occupiers in the industrial space, and there's very little leased assets. So it's been holding its value well. There will be a price mismatch. So basically, vendors will expect a bigger number. Purchasers won't be prepared to pay that number, so there will be a bit of gap in that space. The other area that's very strongly sought after, and I get inquiries on this all the time, commercial storage. Can you buy commercial storage spaces for us? It's a main market that's increasing. Basically, this is a table that was put together based on the different asset classes. And as I said, the biggest opportunities in the marketplace will be in relation to hospitality and retail, where there will be more ability to negotiate, and also they will become more attractive purchasing assets going forward. In any of these situations, lease covenant is critical. So what that means is, making sure that you have a good tenant, ability to pay rent, and ability to withstand volatility. That's it for me.
Ladies and gentlemen, Michael. 5 minutes over. Well done. Thanks so much. All right, ladies and gentlemen, just a big thank you to Michael, Richard and Michael again. They're all staying for lunch, and you're very welcome to have a chat and a debate with them. And thank you so much. Enjoy lunch. Cheers, guys.